Good morning, good afternoon, good evening, folks. What we're doing today with Anna Kelly is describing three paths the Fed can take to attack inflation. Episode one was kind of Ben Bernanke, slow and steady and staying behind. Episode two was Paul Volcker and shake the world, come out of nowhere, kill the economy. And then here in episode three, it will be the one that I think is coming. But before we do that, let's welcome Anna to the show. Hi, Anna.
Hi, great to be here with you as always.
Yes, this is a lot of fun. I love talking because you and I, we've walked the same walk. We've been doing this 20 years, have finance background. So we can play this economy, GDP, inflation game together. So thank you for doing this.
You're welcome.
So this is what I think is coming. And I've actually been saying this for 6 months now. So I feel pretty good about it. I think on March 10th, which I think is the Fed meeting, it might be March 12th, they're going to come out and do half a point. I think between now and March 10th, let's say it is, they're going to talk quarter point because they want to lower expectations. And then they want the half to be a shock. I think the market is smarter than that. I think Wall Street is already pricing in a half, and it will turn out to be not a shock. So I think a half comes out. We haven't done a half point move since 2008.
Yes.
Right? So again, the Fed is very comfortable doing a quarter. A half a point to them is nuts. A full point, like in episode two, not happening in the US. It just happened in Chile. It happened in Colombia, but it won't happen here. Then from there, I think the Fed takes kind of on again, off again approach, meaning the next meeting is nothing and then a quarter point. So I think we get to the end of the year, we're up maybe 1 1/4 by the end of the year. And then next year, again, what I see happening is the Fed's going to be aggressive. And then I think Powell at some point is going to fold like a cheap suit. He's going to act like Paul Volcker. The economy, and let's be clear, Wall Street is going to throw up, and then he's going to back off. So in this scenario, we have some short-term pain. The market wigs out, and then the Fed does what it does. It bails out all their Wall Street folks. I just don't know what happens to inflation in that scenario. So I wanted to ask you, what do you think?
Yeah, no. Yeah. And I love that we've been talking about this for a while, or early on going, inflation is coming. And no. I didn't think it would get this high this quickly, to be honest with you. But yes, we've been saying they have to be aggressive. It's happening too quickly. It's proven not to be transitory. It's continuing to tick up despite them, trying to cool it down. I think they have to come out with a half a point by March. How quickly they come out after that, I'm not sure. But I think that as bad as inflation is, half a point is not going to spook demand enough, right? And so again, if you go back and listen to the first two, all of our rates really have to do with supply and demand. Inflation has to do with supply and demand. Asset prices have to do with supply and demand. So the Fed can't do anything about supply unless they really wreck demand. And then that'll kind of fix the supply issues themselves. But they can only really try to impact demand. They've already been talking about potentially coming out and being more aggressive. And the markets have already rumbled. And the residential and commercial real estate rates have already gone up 0.6 in about a week and a half. It might be a little bit higher even today because they're anticipating that half a point. So I think they come out half a point. I don't think it makes a mass difference yet in demand, to your point, because people are still buying even though rates have tricked up and the 30-year was at 4.02 or 03 yesterday with 0.4 points. I think they have to do half. I don't think the markets rumble as badly as we think, because I think they've already been anticipating it. But if they come up with a half and they quickly follow with another quarter or half, then, it starts to make a little bit of impact in demand. And I think if they hit a point, I think you have a lot more stock market rumblings. And I think that really, really starts to finally slow residential refis, residential, that move up buyer that's looking to buy a nicer house.
Yeah. This scenario just feels most likely to me where they come out, they know they're behind. They want to, let's be clear. These are human beings. They believe in their reputation. Jerome Powell does not want to be known as the transitory guy. Right now, if he retired and all that would ever be written about him was he said it was transitory and it wasn't. So I think he's going to come out hot. I think what's going to happen is we'll see. I think if he comes out hot and then maybe they follow in the next meeting, which is April or May, I think we start to see negative GDP growth. Not only negative real, which I think we'll see. We'll see negative nominal GDP growth.
Right.
And then I think he gets, I think he, I don't know what to say. I think he's a wimp. I think he wimps out, right? I think he's right on the cusp of beating inflation. And then he backs away because GDP goes negative or unemployment goes from 4 to 6. And he's like right there. And then the asset bubble gets blown up again.
They're walking a dangerous tightrope. They really are, because as soon as GDP is negative or GDP rate is less than your debt rate, you've got a problem. If inflation stays higher than GDP, you've got a problem economically. So if we're raising rates, and the Fed, not to miss this point, that's really important. It's different than history. For the first time, the Fed is a net borrower. In the past, they've been a net lender. So they raise rates, it impacts all the other people in the economy, but it doesn't impact the government per se. Mm-hmm. They raise rates, the government is now paying debt back at a higher rate. And if GDP is negative, you've got mass government debt, you've got negative GDP, and that can't last for very long before countries really are in danger. You add to that, I'm going to talk a little Ray Dalio, but you add to that some of these, potential conflicts with Russia and Ukraine and China and Taiwan. We could have a lot more spook and fear in the stock market because of all these things happening together. And it doesn't bode well. So I think he's got to be really careful that if he goes too hot, too fast, the economy could really go into deep recession. So I to your point, I think he comes out fast at first, tries to show they're in charge, mm-hmm. and then they back away and say, okay, we're not going to break it. Mm-hmm. We're going to cool it and just trust us to do it slowly and we'll all be okay. Because I think if he comes out too strong, too fast, that's when markets start to panic.
Yeah. So if we were going to summarize these three scenarios, slow and steady behind the curve, I don't think there's a recession. I don't think. Number two, fast and hard and not backing off. I think a recession and probably a pretty significant one. This third and final scenario, I think if he really wants to dead inflation, I think we need a shallow recession. I just do.
Yes.
Right. I think we get one, but he backs off, right? It's again, a recession is 2 quarters next, back to back of negative GDP. I think we get that, but it's only 2. In the second scenario, I think it could be for 5 or 6 quarters, right? We can have a multi-year recession with negative growth if rates go way up too fast.
Right.
But that's kind of how I break this down. I think the stock market is smoked in the second one. I think commercial real estate's hurt in the second one. Residential transactions stop in the second one. Asset prices stay high in the first one. This third scenario is interesting because I think it'll be so short that stock market is hit a bunch. Real estate doesn't move that fast either way, commercial or residential. So I don't know. That's kind of how I break all this down.
Yeah, I think the balance between, recession and inflation and all of these things, GDP, unemployment, it's just got to be handled very, very carefully. And you can't be too aggressive. You can't be, too weak. So I agree with you. I think they come out fast and then they back off a little bit. To your point about recession, the average recession over history lasts 18 to 24 months. I think it's actually closer to 18, but they typically go 18 to 24. So one of the questions is going to be, with the economy teetering on recession before the pandemic, and yield curve, I believe, just reversed again early this week or late last week. That's a big, flashing red indicator, pretty strong predictor that we're heading to recession. Again, there's so much uncertainty, but I think generally speaking, a recession's about 18 months. So, I tend to think a recession will last a little longer than you think it will, but I could be wrong, and I hope that I'm wrong. Yeah. So we'll just have to wait and see,
Yeah. The unfortunate part of where we are with inflation today, the only way you beat it, in my opinion, is a recession. It's
right.
Negative GDP. You have to break demand. It just has to happen. And because of that, unemployment will go up. It will go from 4 to 6 or 6 to 8, or I see some pain in this scenario. I think there's a lot of pain. I think it is. I can't think of a better analogy. It is ripping the Band-Aid off. Episode number 2 is fast, but horrific, but really painful, sharp.
Right.
Episode 3 is kind of that slow, because they don't want to break anything. Right.
Right.
I don't
And
know.
to your point in episode 2, it's an election year, right? And so they don't want to go into midterms, midterm elections anyway with a recession. So, they're going to try to keep everything as stable as they can. They just don't have a lot of tools in their arsenal other than interest rates at this point. And that, I think that's key, because this is about all they have left right now, at least that we know of, that is currently legal and written into what they can do. It's raising interest rates. So, expect that they're coming up fast. And but it's just part of it. It's part of the cycle. These economies go in cycles and they'll come back. I'm betting on the American economy. I think that we'll weather this. I just think we have to be realistic that there's probably some pain ahead for us investors, at least on the financing side. And if prices come down, that's a good thing for us too. So just keep, planning, mitigating, and keep investing in good times and bad. And we'll all get through this for sure.
Time in the market's better than timing the market.
Yes.
So Anna, how can people find you?
Great. You can find me here almost every Wednesday on One Rental at a Time. You can find me on social, Facebook, LinkedIn, Instagram, Anna Kelly, REI Mom, and greaterpurposecapital.com is where I present multifamily real estate for accredited investors.
Thank you very much.
Thank you.